All right. Hello, everyone. Welcome back to another installment of our Lunch and Learn webinar series. And I'm your host, Mayur Thaker. I am an analyst and senior relationship manager here at Zacks Professional Services. And today we're going to be taking a look at a slightly different topic. Typically, we're talking stocks, but today we're going to be talking a little bit more about what's been on the minds of so many people across Wall Street and across Main Street as well, which is today's highly inflationary period. And the goal of today's webinar is to understand a little bit about the similarities and differences of today's inflation versus historical periods of inflation that we have experienced. And the goal of that is to then understand whether what type of outcome we can expect out of the situation that we're going through today. If history is to be, a good guide as to what might happen this time around. So let's get started. And just a little bit of housekeeping right as we get going here. I've got this disclosures view here. And if at any time during this presentation, if you have questions or if you have any audio issues, hopefully I'm coming through clear. But if there are any audio issues, please do let me know. In the Go to Webinar panel, there is a section for questions, which you can enter into that. So as we all know, we've got this, headline all across the media. I just took one example here from the Wall Street Journal. Last month, when we got the October reading of the CPI index, we see, a massive jump in the CPI, all items index at 6.2% year over year. That's very, very high, relative to history. That's a 31-year high, actually. And the core index, even excluding food and energy prices, that was also up 4.6%. So this is obviously becoming a problem. It has been turning heads all over the nation, and people are wondering what's going on, right? And we can unpack that, that result from the U.S. Department of Labor, and we can see there, I've just highlighted here the all items index. The 12 months ended October 2021 is up 6.2%. The core index up 4.6%. We can see a big part of that is coming from energy. Energy commodities up 49%. Fuel oil up 59%. It's a huge jump in the price of commodities, which is really the major driving force, behind this high CPI read. So let's back up a little bit and think, big picture, first principles reasoning. I always talk about this all the time when thinking about stocks, as well as when thinking about really anything, is whenever there's a problem, we want to take a big picture look and understand what are the core reasons, the source reasons for why something happens. So when we talk about inflation, right, that's basically the phenomenon of prices going up. When would prices go up for something, right? There's only two reasons why the price of any item would go up. One is monetary devaluation, which means that the value of the item that you're using to purchase it has gone down. So there could be a situation where the actual price of that item did not increase, but the measuring stick by which we are paying for that item has decreased in value. So that would be what we would call monetary devaluation. The value of, or the purchasing power of the dollars that we have has gone down. However, there's also price inflation due to a supply-demand imbalance. If demand rises above supply, and if that persists for a long enough time period, then prices can also rise due to that as well. And we're seeing that right now in the used car market, where demand has, soared, but supply has been unable to meet that demand because of various supply chain issues that we know that the car industry is dealing with, the chip shortage all across the industry, all across the world. as well as, factories that are still unable to ramp up production back to, levels seen prior to the pandemic, due to ongoing issues with, filling labor positions, and whatnot. So we see that there are two sources of inflation: monetary and supply and demand imbalance. And I believe, and this is just my personal opinion, obviously there are many viewpoints on this, so I will disclose that and just say that there are counter arguments as well. But my personal opinion is that gold is the ultimate indicator of the first source of inflation that I talked about: monetary devaluation or even appreciation. And sometimes we do get that occasionally. So gold is the ultimate indicator of the monetary source of inflation. So let's take a look at history. What does history tell us as to the cycle of prices over time? So I found this chart here. This is actually a 200-year chart of commodity prices. And the source is Hackett Financial Advisors. And this is a great chart. And this is something that we really should think about and look at very deeply and study. We see that there is a time period before and after. There's two sections of this chart. And you can't see them because I purposely did not highlight the two sections. But the two sections are prior to 1971 and after 1971. So you can see that the period of 1971 is right around here. And there is a marked difference between every time prior to that period and every time after that period. And what is that difference? So we see that there has always been periods of inflation. We saw that the inflation of 1812 occurred during the War of 1812. So we saw the price of commodities rise at that time at 4%. Then the prices, fell pretty steeply down to about 6% annualized and stabilized at that point upon the conclusion of the War of 1812. Then we saw, prices rise again with easy credit, speculative boom up to about 2%. Then once again, prices fell after that bust occurred. Then we saw prices rise pretty sharply during the Civil War period. That went up to almost 8%. And then post-Civil War, after the conclusion of that war, we saw prices fall dramatically after that, again, back into negative territory. Then we saw the Industrial Revolution. So we saw rapid GDP expansion, but then we saw prices ease after that as well, only to pick up again during World War I. And then following World War I, we saw this epic price collapse, back to negative territory by over 4%. Again, ramping up during World War II, crashing after World War II during peacetime of the 1950s, ramping up again during Cold War. So we saw, obviously, there's a cycle here, a macro cycle, where commodities have these periods of booms and busts. However, after 1971, you can see that we had a rapid rise in the price, but then the bust that we saw after that never really fell below zero. Every single time in the pre-1971 era, we saw prices rise and then prices actually fall. Now we see prices rise and the rate of change has indeed fallen, but never went below zero, which means that we are in a permanently higher environment of prices. So whenever this chart, because we're looking at year-over-year percent changes, if the chart never falls below zero, that means that we're still tacking on price inflation. Even if the rate of change has slowed, we're still seeing higher levels of prices. Every other time in history, prices have actually reversed the period of high prices that we saw just prior to that. As we can see there, prices hit negative 4% to even negative 6% at one time, to reverse the high prices that we saw during the prior period. So what is that? What is about 1971 that makes, this era so different from every prior era? And that is, the US was on the gold standard, right? And so here I found another chart going back 100 years roughly, and this is the price of oil. And I think everybody would agree here that oil is probably the most important, this is probably the most important commodity of them all, right? Because we have, the entire economy is based on the price of oil, right? Everything depends on, the price of oil, right? Everything depends on that. We rely on oil for transportation. We rely on it for production. We rely on it for all sorts of fuel, and so on. And so here we can see a chart of the price of oil during the 1920s, 30s, 40s, 50s, 60s, and then 1971 to 1974. Here we see a sudden spike in the price of oil here. And here is that time period that everybody likes to refer back to, and compare where we are today versus where we were in the late 1970s when we last saw a sudden spike in inflation. So this is very interesting because if you know a little bit about what happened in the 1920s, that was a very strong boom period. We had very strong annualized GDP growth. And then we had the bust of the 1930s during the Great Depression. But that recovered by the 1950s upon the conclusion of World War II, and we returned to growth, and really the birth of the middle class in the 1950s. And that was during, the baby boomer period, because the economy was stabilized. People, the economy returned to peacetime, and we had, a huge surge in the birth rate in the 1950s. And that was a time of rapid economic expansion as well. So you can see here that during times of economic expansion in the 1920s and in the 1950s, we saw very stable oil prices. And again, this was because the US was on the gold standard. So the value of dollars were backed by gold. It was a commodity backed, monetary system. And because of that, commodity prices were fairly stable over time. Not to say that they didn't have, price volatility. There was always, price volatility, as we saw in the previous chart there. But the difference is that every time we had price volatility, it would always come back and mean revert. There was always mean reversion. That was the key difference between that time and the time that we see today. Now we don't see such mean reversion as much. We see an era of price volatility and mostly price inflation. So that permanent price inflation began when the US went off the gold standard. And this is actually a typo. It should say 1971, not 1974. So prior to the closing of the gold window, prices did rise and fall, but they did so due to genuine supply and demand imbalances. So as we saw that in our prior slide here, the two sources of inflation, monetary inflation and genuine supply-demand imbalance. So supply and demand imbalances occur due to unforeseen shocks to the economy, such as wartime, such as other events that occur that's outside of our control, such as hurricanes or other natural calamities, things like that. Those are things that we really can't control. We can't plan for, and so those are times that do generate inflation. But we saw that they were always mean reverting. It did take a couple of years to get through it, but they were always mean reverting. However, today we don't necessarily see that, and it's because the dollar that we're using to measure prices by itself has volatility, itself has been devalued, because we went off of a standard in terms of what we should link our dollars to. So prior to 1971, the U.S. Could only increase the money supply as gold reserves would go up. So as gold production increased and as gold reserves were to continue going up, then the U.S. Federal Reserve was able to increase the supply of money. because they could guarantee the convertibility to gold at a certain price. And at that time, it was $35 per ounce of gold. So the only way they can guarantee that convertibility is if they actually had gold in reserves to be able to meet, a potential of individuals or businesses or institutions demanding convertibility. So that was a standard that we abided by. And because of that, we had long-term price stability. There were downsides to that as well, as you can see, because during emergency times, we were unable to run deficits for a very long period of time. We were unable to have emergency fiscal policy and emergency monetary policy to meet recessions. So that's the real reason why the US went off of the gold standard in 1971 and never looked back since then. So that was actually one of the reasons why we did have price stability, massive inflation during the Civil War period, because Lincoln at that time suspended the dollars linked to gold. And that's where that term greenback came from. If anyone remembers a little bit of history, the term greenback was used as a mockery of the US dollar because Lincoln at that time needed funding to fund the Civil War. That was an emergency time in our history. And there was no way possible for the US to be able to fund the Civil War while abiding by the strict standards of the gold standard. So Lincoln suspended the gold standard at that time, and that's what led to rapidly increasing prices at that time. Then upon the conclusion of the Civil War, once that war was resolved, we ended up restructuring the nation and actually came back onto the gold standard. Then we saw prices drop pretty dramatically right there. And that was also during a time of rapid economic expansion during the Industrial Revolution. So GDP actually increased, productivity increased, and that actually helped put a very strong control on prices at that point going forward. So again, the point of this whole entire, history lesson is that, during the gold standard, there was periods of inflation, but those prices would always remain in a sideways channel over the long run, meaning it was always mean reverting at some point. Today, we don't have such a luxury. We don't have that because we don't have a standard on which our dollars are being, priced at. So here's another fascinating little history lesson here. So a dime can buy you a gallon of gasoline today. So how is that possible? I'm telling you right now that one dime can buy you a gallon of gasoline today. So how can that be possible? So in 1964, the price of gasoline in the US was approximately 30 cents a gallon, right? So that's about 3 dimes would buy you a gallon of gasoline in 1964. Today, the price of gasoline is approximately 10 cents a gallon. So you might be saying, Meyer, what are you smoking, right? Gas is not 10 cents a gallon today. So how is that possible? What am I talking about here? So dimes made in 1964 or prior were made with 90% silver. Okay, so the amount of silver in each dime today would be worth approximately $3, right? So that if you take the quantity of silver that's in a 1964 dime, the market value of that dime today, according to today's silver prices, would be roughly $3, which is roughly the nation's national average of gas, of the gas price. So that's amazing, isn't it? So this means that the price in real terms has actually gone down, not up. Production has increased, efficiency has increased. There have been methods of extraction that have gotten, oil production more and more efficient. And so in real terms, the price of oil or the price of gasoline has actually gone down, not up. So the only thing that has changed is the purchasing power of the dollars that we're using to measure the price of gas. So that's the only thing that has changed. Gas used to cost 30 cents a gallon. Now they cost over $3 a gallon. So we think that the price of gas is actually multiplied 10x or even 11x over that time. But in reality, it's the purchasing power of the dollar that it has deteriorated pretty dramatically. If you were on a silver standard, meaning if you converted all of your wages to silver, then you would actually be paying a lower price for gasoline today versus 1964. So the primary takeaway here is that gold, or even silver, is the ultimate proxy for inflation. But gold more so than silver, because silver is slightly more of an industrial metal as well. So in my personal opinion, gold is the proxy for inflation. But what type of inflation? Monetary inflation. We're looking for measuring the purchasing power of the US dollar. So how is today's inflationary environment different? We saw how they're similar today, but how are they different from past sources of inflation? Here I have a chart of the ISM backlog. This is the ISM manufacturing backlog versus the CPI. And I wish I had greater history than this, but the ISM Institute of Supply Management only started this series in the early 1990s, so we don't have greater history than that. But this is a chart that overlays the ISM manufacturing backlog with the all items CPI index year over year. And here we see that 6.2% for the CPI. That's obviously very, very high. That hits a 31 plus year high. But we also see with this a very, very high backlog as well. So keep in mind, we're trying to identify the source of inflation here. If we can identify the source of inflation, that'll tell us a little bit about what the eventual outcome of this inflation might be. If the inflation is primarily monetary in nature, meaning if it's primarily driven due to a deterioration of the purchasing power of the dollar, that is much harder for us to come back to, unless if the Fed engages in extremely restrictive or tightening monetary policy. If the source of inflation is primarily supply and demand imbalance driven, then I believe personally that this high inflation rate that we're seeing in the CPI will eventually come down. Why? Because that is the nature of supply and demand. As demand outpaces supply, prices rise. As prices rise, that actually incentivizes production, because it means that there's greater incentive or greater profit margins for for individuals to be able to realize if they were to enter that specific market. So we see the backlog is still very, very high. It hit an extreme high reading of 71, which is also a 30 plus year all-time high, essentially. However, check out what's been happening lately as of the most recent read. We saw the backlog come down, then it went back up. I actually had a webinar of this back then as well. I saw that the backlog was coming back up there, so I thought that maybe that drop was just temporary, and we still see a very elevated backlog number. But now the backlog has actually come down. We see the backlog now at 71.9, still very high, but we see that the backlog is starting to decrease here. And if you look at history, the backlog coming down has preceded or has been a leading indicator of the CPI index. So that's actually very interesting there to see. You can see that directly from this chart that the backlog hit a very high point in 2003. It started to ease pretty dramatically there, and then inflation did take about a year and a half or so, but it did come down as well. So that's why what I believe is that if this backlog does start to decrease, meaning if producers, if factories, if production is able to finally meet the backlog of orders, then we will finally start to see a decline in the CPI index. But it may take a couple of years to do that. So that's the other thing that I think we need to keep an eye on, is that ISM manufacturing backlog. And we also want to make sure that it's not that, demand is decreasing, because remember, backlog could come down if supply is coming online to meet demand. However, backlog could also come down if there is a decrease in demand as well. So that's not what we want to see, right? We don't want to see falling demand, because that could be an indication of a recession. That could be an indication of slowing GDP. So if demand is coming down, that's not a good thing at all. So we want to see the backlog come down, but we want to see it come down because supply is coming up to meet demand, not because demand is coming down to meet supply. And how do we make sure of that, right? We can look at that based on factory orders. Factory orders is another really, really favorite of mine. And we can see that factory orders have actually recovered the entire pandemic drop. And now it's back to long-term trend growth. You can see that there. Factory orders really plummeted during the first half of 2020 as that pandemic shock hit everybody, and the lockdowns really destroyed essentially everything in the economy. But now we see through the most recent period here, factory orders are back up and back onto almost, back onto long-term trend. We did see factory orders stagnate a little bit here during, 2018, 2019, but we're now back, above that level today. So that's very, very healthy to see. So that means that, this drop in the ISM backlog index is due to suppliers, is due to factories finally coming up a little bit to meet some of that excess demand. So that's very, very healthy to see. The other thing too is to look at is gold versus the CPI, right? And this is another favorite of mine, obviously, because gold is such an important indicator of monetary inflation. And the CPI is a mix of both, monetary inflation and supply demand imbalance, right? So we can help identify and isolate the source of the increase in that CPI index. Again, we're seeing that very high read there of 6.2%. Again, that takes us all the way back to the peak of 1990 to get a similarly high CPI read here. But check out where we were in the late 1970s. That was just insane at almost 15% annualized growth in the CPI index, as well as the early 1970s there of almost 12% there. But you can see that each of those periods in history, right, we saw in the late 1970s and in the early 70s, both of those times were periods of very high inflation. We saw gold also have a very, very high rate of change as well. Gold hit a rate of change that essentially doubled. You can see that the rate of change of gold is on the left-hand axis, and the rate of change of the CPI is on the right side axis. And we saw a rapidly rising CPI index and a rapidly rising, gold price as well. Gold doubled in 1973 year over year, 1974 as well. And then gold, almost tripled in the late 1970s. And this continued for several years. We saw, a 70% rise in, 1978. And then, a 180% rise in 1979. And then it plummeted after that, right? But we saw for multiple years gold stack on, a multi-bagger return over that time period, alongside very, very high CPI read. However, if you look at what's happening today, that's a little bit different. We see a rapidly rising CPI, and yet fairly muted gold price. That's interesting to note. That's something that's noteworthy in my view. Now, if this starts to change, then obviously we would have to reevaluate our ideas here. But gold is really only up 2.4% year over year, despite a very high CPI read. So that is a very stark contrast to what we saw in the late 1970s. And I know a lot of folks are drawing comparisons to the 1970s, but this is one major difference that I see here. And this chart, I think, does a great job of just very quickly and easily highlighting that visually, the difference there, that divergence that we see here. In the 1970s, we saw gold and the CPI move together in a very strong positive correlation. But right now, we're seeing that correlation break down. We don't see a rapidly rising gold price right now. This is similar to what we saw in the late 1980s. If you see this right here, the price of or the CPI index really hit a high here, and this is very interesting to see. The CPI actually hit 6.2%, which is exactly where we're at today, year over year. But the gold price was really not doing much at that time, right? It was actually roughly around where it is today, slightly better than where it was today. So that means that even today, the price of gold year over year, price change is actually even below what we saw, in that late 1980s period. Okay. So that was a very interesting similarity here. And ultimately, look what happened to the CPI after that. CPI finally collapsed and we saw it stabilize, in the low 2 to 3% range, which is really where the Fed wants to target anyway, long term. So in my view, gold was actually giving, in this case at least, gold was actually giving you the right signal as to what the CPI would eventually do. So this means that the rise in the CPI was not due to monetary devaluation, right? In this particular case, it was due more to supply demand imbalance. And if it's due to supply and demand imbalance, typically what that means is that supply demand imbalance usually reverts itself out. So whenever we have inflation that is due to that, in the long run or even in the medium run, those inflationary prices do, substantiate a little bit and moderate a little bit and come down. And so that's what gold was really signaling to you back then in the late 1980s there. So if this continues right now, exactly what we're seeing here, a high CPI, but a very muted gold price, then I think that, the late 1980s would be a similar time period that we would, possibly accept as being the eventual outcome of what we're seeing today. Now, it did take a couple of years because think about this: we hit a low, in 1987, and then we hit a high in the CPI in 1990. So that was a 3-year period of high inflation, right? Almost, I'd say about 2.5 years of high inflation. We've been in roughly 1 year of high inflation. So there could be some more left in the tank, right? So we could see, CPI stay elevated at this level for another year, maybe year and a half, if the late 1980s is a guide for us. So that is something to keep in mind as well. And this is also just showing a little bit of a correlation here. So this is something, again, the Zacks research system allows you to do. That's, again, our flagship institutional equity research platform. All the charts that you're seeing here, by the way, are from the ZRS system. And this allows you to run a regression against the two. You can see here that, the gold price has a 15-month ideal optimal lag, which means that what the gold price is doing gives you a 15-month head start or advance notice as to what the CPI will do. And the correlation actually is a pretty strong one. Not super strong, but relatively strong. It's about 54% positive correlation. So, obviously there's a lot to this. It's not super simple all the time. Gold isn't, just a surefire bet every single time to explain away everything the CPI, but I still think that this correlation is notable to look at. And we can just visually see that there are, periods in which gold does positively correlate, and there are periods in which it negatively correlates. And That's the reason why the correlation isn't higher. But it's because, remember, the CPI is a hybrid of both monetary inflation and supply and demand imbalance related inflation. So that's why there are both periods of positive correlation and negative correlation. So that's why the correlation isn't as strong as one would hope, but it still gives us a very, very important read as to the source of the inflation that we're seeing in the CPI. Okay. Here's another reason, another very, very important chart to look at, which is the federal surplus and deficit versus gold. And this gives us a very strong correlation. You can see here that, similar to today, right? This is actually one similarity that we see from the 1970s to today, which is that we had, a massive fiscal deficit. So that was during the Nixon administration, as well as the Carter administration. That entire decade was defined by massive deficits. And right now, you really can't see it. It doesn't really register on the chart because this is more of a linear y-axis here. But at the time, the deficit relative to GDP was massive. It was actually pretty similar to where we are today. In terms of, actually, I think today is worse in terms of the deficit to GDP ratio. So that's one thing that is similar to the 1970s period, is massive, massive deficits relative to the size of the economy, relative to GDP. And you can see here that gold has a very strong correlation to the surplus or deficit. We see that during the deficit period, gold had a massive rise. And during, strong periods, during surplus periods, gold has a very negative, period of returns. So we saw during the 1990s, actually, during the end of the Clinton administration, we actually ran a surplus, if anyone even knows or remembers what that word even feels like. But the government actually had more in income than they did in expenditures. That seems like a far distant memory, but there was once upon a time a period in which we had that. So during that time period, we saw gold had very negative returns. And then once again, we ran into massive deficits during the Bush administration, stabilized a little bit, but then again, during the Obama administration, stabilized a little bit, but then once again, huge negative deficits during the Trump administration and into today as well under the Biden administration. So, we've seen an era of massive deficits, deficit spending. So that deficit spending has to be, monetized in some way, because you can't permanently run a deficit without having that deficit funded in some way. And so obviously the government has tapped into debt in a huge way, to pay for these short-term funding gaps. And so when, when bonds are issued at that rate, unless if the private market is eating up those bonds, that has to be paid for somehow. And obviously we know who has been a big buyer of U.S. Treasuries, and that is the Federal Reserve. And the Federal Reserve can only do that by issuing currency to do it. And so that would be monetary devaluation. That would be monetary inflation. So during this era of huge deficits, we saw this huge run up in the price of gold, starting in the 2000s and really, escalating now. However, we can see, just like what we saw in that chart with the CPI, we see this huge deficit right here, this massive lower low that we see. We've been putting in lower highs and lower lows really over the last 20 years since we hit this peak here in 1999 during the tail end of the Clinton administration. Lower lows, lower highs, bigger and bigger deficits. However, gold has really languished. It has not had significantly higher highs. So that means that there's something that has to give here. Either gold is getting ready for an explosion, really an explosion to the upside, or the deficit is getting ready to come back in. or trimmed a little bit here. So we see a little bit of trimming here so far in 2021. You can see this little bit of an uptick, but that's nothing. I mean, I don't consider that to be really an indication that this is about to reverse, right? And obviously, we saw that, the government just now passed, these, the economic stimulus plan, right, with infrastructure spending. So that's even more spending that's about to hit the tapes. But we'll see what happens with tax revenue this year. Perhaps tax revenue bounces back in a big way, and that helps pay for, the majority of that. We will see what happens there. But we have started to see that deficit trim a little bit here. So maybe the gold market is saying, okay, let's wait and see what that does. And perhaps if tax revenue is strong enough, if we do see, a bounce back in GDP, if we do see further strength in the equity markets, perhaps tax revenue from corporate income taxes, personal income taxes, and capital gains taxes are strong enough to be able to trim this deficit. If that is the case, then gold perhaps will stay muted as well. So we will see what that does here. So the key takeaway again is to keep a very keen eye on the gold price. If that price of gold really skyrockets, then I think that there is risk of monetary devaluation, becoming systemic and something that the Fed is going to have difficulty controlling. Here is a similar chart. Again, it's kind of an overlay chart. Just helps you see the correlation a little bit better. And so you can see that during times of deficits, the price of gold really skyrockets. And during the times of surpluses, the price of gold really languishes. So you can see that negative correlation very, very strong here. Another thing to keep an eye on, this is something that's different from the 1970s hyperinflation, is the spread of interest rates. And here we see the spread between the 10-year Treasury yield and the 1-year Treasury yield. And we saw that during the late 1970s, the yield curve inverted. And that was a pretty strong inverted yield curve here. So we saw that the 1-year yield, right, the short end of the yield curve was significantly higher than the 10-year. And that hit roughly a low of, 3%, negative 3%. So that means that the 1-year Treasury yield hit a low, basically was 300 basis points higher than the yield on the 10-year. Today, there's nothing like that at all. The 10-year is about 138 basis points higher than the 1-year Treasury bill right now. And some might say, well, that's obvious because the Fed is holding interest rates very, very low for very long. So this tells us nothing. Fair point. So let's look at the 10s versus 30s. And here we see a similar thing. The Fed can hold hostage the very short end of the yield curve. That's true. But that's a little bit less true for the longer end of the yield curve, 10s and 30s. It still does apply to a certain degree, but it's to a lesser extent versus ones and shorter. And here we see the inversion of the yield curve during that time as well. The 10-year Treasury yield did surpass the yield on the 30-year note, the 30-year long bond, by roughly 77 basis points at the very low point of 1980. But here we see nothing like that. Now that is coming down. So that is coming down here. We did see an inversion right before, roughly, what was that, 2018? We saw, a strong recovery of that, but now we are seeing that come down a little bit right now. However, it's not low enough for us to be alarmed and start to say that, okay, this is, 1970s style, hyperinflation just yet. So far, the bond market has not, indicated significantly that inflation is runaway and about to become, out of control by the Fed. So we've seen the 10s and 30s spread at this level multiple times in the past. We saw this even in the 1990s. Remember, that was during the time when we were running a fiscal surplus. And that time, the the spread between 10s and 30s were actually similar to where we see today. So just yet, although this is coming down here, I don't want to see as much. This is actually something that's still within historical norms during times where we did not see such periods of rampant inflation. So the bond market right now, at least in my view, is not indicating significant inflation just yet. So, again, a history lesson a little bit here. The 1970s, came that inflationary period really came amidst some incredible sequence of events. It started with the Economic Stabilization Act of 1970. We were actually looking at price controls. The Nixon administration put on price ceilings on gasoline. You could even imagine such things today. But there were price ceilings on gas. There was also, if anyone lived through that period, there was mandated alternate days of fueling at gas stations. So they had a policy back then where if your license plate ended on an even number, you could only refuel at gas station on certain days, and if it ended on an odd number, those were different days that you were allowed to go to the gas station. So there were, this is a photograph from that time period, but there were widespread shortages as a result of both of these policies. Rampant price controls as well as these really crazy periods of regulatory policy. There was a dollar devaluation, as I mentioned. Prior to 1971, the dollar was linked to gold at $35 per ounce. And Nixon declared that we're ending that for once and for all. We're going to the policy of Keynesianism, which is the policy of the British economist John Maynard Keynes, which basically called for a breaking of any linkage of the dollar or any currency to any sort of arbitrary item like gold. And so we went through a period of dollar devaluation during that time. OPEC also had an oil embargo against the U.S. in 1973 that also delivered a supply shock to the U.S. back then. Then there was the Iranian Revolution of 1979. That was another supply shock. The oil markets were, panicking based on that. Perhaps that the supply of oil would be severely limited there. So gasoline during that entire time went from 30 cents to over $4 a gallon. So think about that in real terms. I mean, $4 a gallon back then, right? That would be a significantly higher price in real terms relative to the median wage back then versus the median wages today. We're not even at $4 a gallon on a national average basis today. So imagine how expensive that would have been for the middle class back then, right? So that's a very, very different time period. It's a very different environment from what we see here today. So the key takeaways here is I would look to gold for clues on whether this is major monetary policy error by the Fed, or if most of this inflation is a supply shock. So keep a very close eye on gold. That's what I'm looking at for clues here. Look to the 10s, 30s Treasury spread for signs of concerning hyperinflation. If we start to see that spread invert, then we will start to look like 1970 again, similar to what gold would be telling us. I would also look for that ISM manufacturing backlog, right, for signs whether the supply chain issues we're facing are easing. And I should also caveat that with looking at not just the backlog, but also looking at factory orders, because we want to make sure that the backlog is coming down for healthy reasons, meaning reasons of increasing production, not coming down because of decreasing demand, right, for industrial products. So we want to look for easing ISM manufacturing backlog while factory orders remain strong. Okay. If that's not the case, then we would start to look like that would start to look like a recession. Supply shocks are temporary, but as we see in the data, it can take several years to resolve. So even if the inflation that we're seeing today in the core CPI index, even if that is almost entirely, supply demand imbalance driven, it is still likely, based on history, that that high inflation will continue for at least another year. So it will take several years total to resolve. We're about 1 year into that. So it may take another year, year and a half before we actually see that CPI come back down to more reasonable long-term levels. So that's the sort of, in my view, the best case scenario, is that we see that ISM stay very elevated for at least through 2022 and into the first half of 2023. That's the best case scenario. And the worst case scenario is that it does start to deteriorate, where we see gold, gap up in a big way, and the treasury spread invert, and then that ends up bleeding into the economy and hitting demand, where prices are so high that triggers a recession, similar to what we saw in the 1970s. So in my view, the Fed should begin tapering the emergency policies as soon as possible, which they have indicated that they would do. And even consider a small uptick in the Fed funds rate to compensate for this persistent inflation over the medium term. Since I personally think, based on the historical data that we just saw, I think that this inflation is going to stay high for at least another year, year and a half. So I think that a interest rate increase is warranted, at least 25 basis points, maybe even 50 basis points, just to help compensate for savers, to cope with this type of high inflation here for another year and a half. So that is the key takeaway here for today's presentation. I hope you found this overall analysis helpful. I'd love to hear feedback and comments, questions. And I could take some questions here. I think there is one question in the GoToMeeting panel, so I'm just going to open that up here. The question is, the change you are highlighting appears to have started post-World War II, not post-1971. Oh yeah, that's a good question. That's a good, note as well. I think the question is referring to the chart that we saw in that 200-year super cycle of commodities. You're saying that the change appears to have started after World War II, not post 1971. Yeah, that's correct. Yes, you are correct in saying that there. That the change has started after that. And if you actually look at a little bit of history as to why that might be, the gold standard was manipulated during the World War II period as well. That was during the time of FDR and prior to World War II. And that was during the 1970s. That was during the late 1920s Great Depression, or the stock market crash. The price of gold, I believe, was linked at about $18 per ounce. Don't quote me on that, but I think it's around that level. That was the level that it was pegged to for a very, very long time. I think it was around $18 to $20 per ounce of gold. And that was then devalued to $35 per ounce. So we still had a gold standard that was under what they call the Bretton Woods system. But there was a period of devaluation there. So that's why we saw that the price level of commodities never really changed, there was a marked difference between pre-World War II and post-World War II. So we did see that prices decline post-World War II, but it always remained above zero, as you can see there. So thank you for that note. That's a good point there. But again, I think that's partially due to the fact that, the gold standard, although we still had it in the 1950s, it was changed. It was devalued from about $18 to $20 an ounce of gold to $35 an ounce. So gold standard can exist while having some manipulation in in that dollar convertibility to gold. Another question is, are you concerned that Bitcoin and other cryptos are taking the place of gold in terms of the significance it plays according to your presentation? Great question. That question remains to be seen. I haven't formed a strong opinion on that. I suspect that that is the case. I do suspect that that is the case because I know I have noticed, at least in the discussion on social media, that people that were once strong on gold, or people that are once sound money advocates, have turned to Bitcoin as the answer to this problem that we have seen since 2008. Ever since 2008, the great financial crash, we have entered a new period of monetary policy experimentation with quantitative easing, the likes of which we've never seen in the past. So that's a great question. I would keep an eye on Bitcoin as well as gold. But yes, you are right that Bitcoin may be taking the place of gold, at least marginally speaking. So perhaps the importance of gold and the price of gold may not be as good as it once was. But I still think gold is something that should be kept an eye on. So let's table that for a little bit here and see where that takes us. But that's a great question overall. I still think that, again, gold, though, the market cap of gold is much bigger than the market cap of Bitcoin, by the way. So although the price of Bitcoin has skyrocketed and has really risen, at the margin, it may be taking some share away from gold. But remember, another thing, too, to keep an eye on is that the rise of a alternative now that I'm thinking through this, the rise of alternative monetary standards such as Bitcoin is nothing new. Because keep in mind, during the gold standard, right, there were also by default other standards as well. There was a silver standard. There was a salt standard. Actually, if you go back long enough in history, salt was actually used as a form of adequate payment. That dates us back to the 1600s. Back in Italy, salt was actually used as an acceptable form of payment. So although gold is the universal sort of acceptable mode of payment, you can see throughout history, throughout thousands of years of civilization, every single culture in history, every single time period, everyone has accepted gold as adequate and satisfactory form of payment, right? But that does not preclude that other things are not acceptable forms of payment either. So silver was perfectly good as an acceptable form of payment. Salt was a great acceptable form of payment. I'm sure platinum is an acceptable form of payment by most people. Diamonds are an acceptable form of payment by most people. Anything that is considered of value, of use value, is an acceptable form of payment. So that means that even if Bitcoin were to rise and challenge the market cap of gold, that doesn't necessarily mean that gold is being supplanted by Bitcoin. It means that there is a new standard by which people are also accepting as adequate form of payment. So this is something to keep an eye on. So I think that even if cryptocurrencies do rise, it doesn't necessarily mean that gold is losing its position in the world or gold is being replaced, because there's never been a time in history where only one thing has been the default monetary standard, right? Although the US dollar was linked to gold, even if gold was the direct link, by default, other commodities were also linked to gold because the convertibility of gold to other commodities such as silver was also pretty fixed. That was also fairly flat in a sideways channel for a very long period of time. So that means that, again, the rise in the price of Bitcoin one way, it means that Bitcoin is rising in acceptability and in market adoption, and will one day reach a point where it will, essentially go sideways relative to gold eventually, I believe. So that just simply means that's more a testament to Bitcoin rather than an indictment of gold. So that's something to keep an eye on as well. Is the rise of gold, the rise of Bitcoin as a new acceptable monetary standard, but not necessarily a an indictment of gold. So I still think that gold has a very strong use or at least analytical power when it comes to doing these things. What's your opinion on Kathy Wood and the theory that will lead significantly deflationary effects from technology like AI, renewables, robotics? Great question. I totally agree with that. I love that viewpoint. I think that there are significant technologies that are coming online that will provide strong deflationary pressure, specifically from the rise of electric vehicles. The average selling price of EVs are coming down pretty rapidly, which means that, more people will be able to afford them. And the cost of, ongoing maintenance and upkeep and the cost of electricity is way cheaper than the price of gasoline. So, that's a very, very strong deflationary effect. A lot of companies are working on automation. A lot of companies are working on robotics, such as Teradyne and others, where, they're assisting, factories to be more and more automated. So this is all deflationary in nature. There's a lot of great things coming in the world of biotechnology as well. Great new experiments coming in genomics. So I think Kathy Wood is going to be right in the long run over the next decade or so. I just don't think that she's going to be right in the short run over the next 1 to 2 years. In the long run, though, I think she will be proven correct that, these amazing new technologies that are coming up are going to challenge and overwhelm, inflation over the next decade. Is there a recording of this webinar where I can rewatch? If you did miss the first part of this, yes, we are going to be uploading this question to this entire webinar to YouTube. And last question: am I wrong to think that it also looks like there is only one direction in which inflation, in a macro sense? The chart shows higher highs and higher lows in inflation since 1804. Yeah, you might be correct. I didn't compile the CAGR overall. It does look like there are higher highs here, like for example in the Civil War period. But keep in mind, the Civil War, as I mentioned, that time was when we went off of the gold standard, right? So this is actually, again, not an indictment of the gold standard. This is actually a testament to what happens when you go off of a monetary standard. So this, very high inflation rate of 8% was during a time when we were off the gold standard and we printed greenbacks to fund the Civil War. Then this, very strong deflationary period was when we returned to peacetime and when we went back onto the gold standard. But you might be right. There could be times where the overall CAGR here is positive in that sense. But I think a big part of that would be this time period right here when we went off of that gold standard. When we went off the gold standard there. But the idea here is that comes up right after that is the price of oil. Like if we go back to that and see that's here. I mean, this would be incredible if you think about it. Imagine if, businesses could invest with high confidence that the price of my inputs are going to be roughly the same today, 20 years from now or 30 years from now. Imagine what that would do to business confidence or consumer confidence, or what that would do to long-term capital expenditures, long-term, capital investments. That would provide a lot of stability and a lot of increased confidence in business and in consumers, to make long-term decisions. So this was a very, very strong period where we had strong growth and yet stable prices. So that, in my view, is a great, great attribute of things like the gold standard, or having some standard by which to base the growth of the money supply. Whereas today, we see nothing but price volatility and mostly price increases the moment that we went off the gold standard. So, I think that, overall, we had very, very stable prices during the time of the gold standard. The downside, though, however, and this is the main reason why, policymakers and economists convinced governments to go off the gold standard, is because it lets it forces governments to maintain fiscal austerity, because it's very, very difficult to run big deficits for very long under the gold standard. It also forces governments to play by the rules. So you would have to accept the interest rates that the market, presents to you. You really cannot manipulate interest rates under the gold standard. It's just not possible to do for a very long time. And then QE is virtually impossible to do. So there would be no way for the Fed to radically expand the balance sheet with, new money creation to buy bonds to artificially depress interest rates. So these are all things that the gold standard forces governments to do, and that's really the reason why we went off of that, because we really can't answer, we really can't do things during times of economic crisis. So hopefully this was a helpful and interesting webinar. I know we're way over our time here, so if you do have any further questions, I'd love to hear from you. This was a lot of really great questions. If you do have any others, please do reach out to us. If you are a ZRS client, please send us an email to zrs@zacks.com. And if you're an advisory tools client, please do send us, your feedback, thoughts, questions to zat@zacks.com. All right, everyone. Hope you found this helpful, and looking forward to the next one. Take care, everyone.